Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, RSI Explained, Reading the Relative Strength Index.
Yes, and I'm really excited for this one because, honestly, this is a game changer for anyone looking at charts.
Totally. I mean, if you've ever, stared at a stock chart and watched a line just go up and you're thinking, I want to buy it, but man, what if I'm buying at the absolute peak? Well, today's deep dive is absolutely for you.
Yeah, that fear of buying the top is, it's so real. We've all been there.
Right. So we're pulling our insights today primarily from the daily market briefing from June 27th, 2026. And we're going to combine that with some foundational wisdom from the CFA Institute and Investopedia to basically just demystify the RSI for you. And we're going to do it without all the intimidating Wall Street jargon.
Which is much needed, honestly. Before we even look at any math or formulas, we really need to understand what this tool actually is, who created it, and, why it actually matters to your portfolio.
Yeah, so where does this even come from?
Well, it's actually pretty fascinating. The RSI was developed by a guy named J. Wells Wilder. He was a mechanical engineer, actually.
Oh, wow. Not a finance guy.
No, an engineer. And he introduced this back in 1978. He published it in his book called New Concepts in Technical Trading Systems. And he also put it in Commodities magazine.
Which, just a quick side note, people today might actually know that magazine under its new name, right? Modern Trader.
Exactly, yeah. Modern Trader. So in the technical analysis world, the RSI is officially classified as a momentum oscillator.
Right.
And basically that just means it measures the velocity and the magnitude of price movements.
Okay, let's unpack this because, momentum oscillator measuring velocity and magnitude sounds like we're back in a university physics class.
It really does.
So to make sense of this, let's ground it in reality. If you think about looking at a stock's price on a chart, that's basically like looking at a car's location on a map.
Okay, I like that.
The map tells you exactly where the car has been, but the RSI is basically the car speedometer. It tells you if the stock is accelerating way too fast and might be, due for a speed trap, or if it's just totally run out of gas.
That is a great analogy. And I'd even say it's like the tachometer, too. The dashboard is telling you if the engine is just redlining because you've had the gas pedal floored for miles.
Oh, right, because the engine's going to blow if you keep that up.
Exactly. And connecting this back to you, the investor, the CFA Institute, and Investopedia point out that this speedometer helps identify potential trading opportunities. It does this by signaling when an asset is either overbought or oversold.
Overbought meaning it's time to sell, and oversold meaning maybe it's time to buy.
Broadly speaking, yes.
So now that we know the RSI is essentially this financial speedometer, how do we actually read it? What does the dashboard actually look like?
So the standard time frame Wilder used, and the one everyone still uses, is 14 days.
Just a flat 2 weeks.
Right. And it plots on a scale from 0 to 100. You're never going to see an RSI of 150 or -10. It is mathematically locked between 0 and 100.
Gotcha. And on that 0 to 100 scale, what are the speed limits, the boundaries we need to care about?
There are three main lines you need to look at. There's an upper line at 70, there's a lower line drawn at 30, and then there's a dashed midline right in the middle at 50.
Okay, 70, 30, and 50. Let's actually walk through a concrete example so we can see how this math plots on the graph. The daily market briefing had a really good hypothetical for this.
Yeah, let's do it.
So imagine you're tracking a stock and you've got 14 days of closing prices. On day one, it starts at $50, and then it just climbs steadily day after day until it hits $115 by day 14.
That is a massive run-up.
Huge. So the formula says we first need to find the RS, which stands for relative strength. And to get that, we divide the average gain by the average loss over those 14 days.
Right. So let's say for this example, on the days the stock went up, the average gain was $5. And on the occasional day it stumbled, the average loss was just $2.
Okay, so the RS is $5 divided by $2, which equals 2.5.
Exactly. The buyers are overpowering the sellers 2.5 to 1. Now we just plug that RS number into the main formula, which is RSI equals 100 minus.
Wait, let me make sure I'm following. 100 minus what?
100 minus, in brackets, 100 divided by 1 plus the RS. So in our case, it's 100 minus 100 over 1 plus 2.5.
Right. Okay, so 1 plus 2.5 is 3.5. So 100 divided by 3.5 is roughly 28.57. And then 100 minus 28.57 gives us a final RSI of 71.43.
Got it. That's the exact number.
Okay, but hold on. Stop the math right there. So what does this all mean? I have the number 71.43, but what is that actually telling me to do?
Well, look at where that number sits on our 0 to 100 scale. Because 71.43 crosses above that upper 70 line we talked about. The stock is now officially considered overbought.
It crossed the 70 speed limit.
Exactly. The speedometer is flashing red.
Okay, so we just proved that our hypothetical stock is overbought. Does that mean you should just, instantly log into your brokerage and hit the sell button?
No, not so fast.
Yeah.
And this is honestly where the biggest pitfalls happen.
Right, because people think it's a guarantee.
Yeah, they treat it like a foolproof crystal ball, and it is not. The CFA Institute explicitly warns that the indicator is highly subject to false signals. You really have to interpret it cautiously.
And Investopedia backs that up too, right?
Yeah.
They stress that relying solely on the RSI is basically dangerous. You have to use it alongside other technical and fundamental analysis tools to actually get a complete view of the market.
Exactly. It's just one tool in the toolbox.
But wait, let me play devil's advocate here. If it gives false signals, why bother using it at all? Like, why calculate 71.43 if the stock might just keep going up to $150 anyway?
Because a warning sign isn't a stop sign. Think of it like this.
Oh, wait, it's kind of like an alarm system, right? Like a smoke detector.
Yes, perfect analogy.
Like, just because your smoke detector goes off when you burn some toast in the kitchen, that doesn't mean you just throw the detector in the trash.
Right, you don't say, well, smoke detectors are useless.
Yeah, exactly. You just use your other senses to verify if there's an actual fire. You look at other evidence like fundamental analysis to see if the house is really burning down. The RSI hitting 70 is just the alarm blaring, saying, hey, things are getting extremely hot over here.
That is exactly how you should look at it. And what's fascinating here is how the real pros use it. They don't just buy at 30 and sell at 70. They look for something called divergence.
Divergence. Okay, what is that?
This is an advanced concept.
No.
Divergence happens when the RSI line and the actual price of the stock start moving in completely opposite directions.
Wait, really? How does that happen? Because shouldn't they be tied together? If the price goes up, shouldn't the momentum go up?
You would think so, right? Under normal conditions, yes.
Mm-hmm.
But imagine a stock makes a brand new high. It jumps from $100 up to $120. Everyone's cheering, the news is celebrating.
Right, everyone thinks it's a massive win.
But then you look down at the RSI indicator, and the RSI didn't make a new high. In fact, it made a lower high.
Oh, wow. So the price went up, but the underlying momentum actually went down.
Yes. And that is a massive clue. It means the buying pressure is fundamentally exhausted. The last few buyers are just trickling in, but the aggressive energy from last week is totally gone.
It's like the car is still creeping forward up the hill, but the engine is totally dead and gravity is about to take over.
Exactly. That's bearish divergence. And it is an incredibly strong indication of a major market turning point. It flashes a warning sign before the actual price chart even reverses.
That is so cool. Okay, let's zoom out and just review the key takeaways you need to remember before your next trade, because we covered a lot of ground here.
I really did.
So first, the RSI measures momentum. It's your financial speedometer.
Yep.
Second, it usually looks at a 14-day window. Third, it treats anything above 70 as overbought and anything below 30 as oversold.
Right, they're guardrails.
And finally, it must be used as part of a broader tool set to avoid false signals. Don't just blindly trade the 70 and 30 lines. Look for the fire behind the smoke and watch out for that divergence.
Nailed it. But, before we go, I want to leave everyone with one final thing to just ponder.
Oh, I love a good thought experiment. Lay it on us.
So we know J. Wells Wilder published this exact formula back in 1978, right?
Yeah, pre-internet, guy with a pencil and graph paper.
Right. Well, today, millions of human traders and massive, super-fast algorithms are all looking at that exact same 1978 formula. Everyone knows that 70 means overbought and 30 means oversold.
Right, the whole market is staring at the exact same dashboard.
Exactly. So my question is, does the RSI occasionally become a self-fulfilling prophecy?
Oh, man, that's a deep question.
Like if an algorithm is programmed to sell the millisecond the RSI hits 71 and thousands of bots do that all at once, the price drops. But did the market naturally run out of steam? Or did the turning point happen simply because the crowd expected it to happen based on this one math formula?
That is wild. It's like, did the momentum die or did the indicator just spook everyone into selling?
Exactly. It really makes you wonder who was actually driving the car at this point.
Seriously, I'm going to be thinking about that all day. Well, that's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.